Monday, April 4th, 2022, Monaco 64, home of alternative economics and contrarian views. We're going to look at the miners, the gold and silver miners, and bullion, and how it looks like the miners are starting to lead bullion. Does that mean that gold and silver bullion are going to go down? No, it means that really they could kick off. And why is that? Well, because the miners usually lead the way. Before I start though, I like to say, this is not financial advice. This is my opinion. And if you are interested in investing in the miners, you should do your due diligence and do your homework. I'm just giving my opinion here, as I said. And nothing beats a solid financial foundation. And what do I mean by that? Well, I think people, I guess it depends a little bit on your age. You should always be trying to have as little debt as possible. I know some people like Robert Kiyosaki think that it's good to get a lot of debt to leverage. Maybe so when you're younger, I would say. But also try to pay off that debt. Try to have a budget every month so you know what you're doing, what your financial situation is. And once you are on a solid foundation where you can also accumulate and save real money, by that I mean physical gold and silver, and other things as well you might want to have, tangible hard assets. Then you can think about speculating, because I would say that's what investing is all about. People forget many years ago, back in the late, let's say 19th century, early 20th century, only the very wealthy could invest in the stock market. This culture of stock market investing has been pushed on the general public, mainly because the currency that we've had for the last 50, 60 years is not fit for purpose. You can't really save the fiat currency because it loses its value. Am I saying investing is bad? No, but I think people need to be aware of that. And that's why I think my financial foundation would be as if I was back in the 19th century. Yeah, it seems outdated, but I think a lot of times you can learn from the past. So we're going to look at that today. Billy and I have been out this morning. It's pouring and very windy, but Billy is a really good dog. He doesn't care about wind, snow, or rain. So we've been out. I dried him, so he's nice and warm now. It's still quite cold here. And yes, as per physical gold and silver, again, people ask me where they can get physical gold and silver. Well, I have a referral or promo code with Gold Investments in London. They've been in business for 40 years, family-run business. And promo code is Monaco64. They'll give you a personalized service, Oliver and Simon. There are other ways, of course, of owning gold. It's not physical, of course, holding gold, but through Glint. A lot of people like Glint, and I have a referral code there too, Mario Glint79. They'll provide you with a MasterCard, and they'll store your gold, allocated gold, in a vault in Switzerland. So let's go and look at the miners and what's going on here. And we're going to look at as well at the gold and silver ratio. I've noticed in the last few weeks, ever since gold topped above 2000 and has corrected, and silver as well has been correcting, that my mining stocks have done really well. And on Friday, they closed that my portfolio is the highest it's been since I started loading up on miners over a year ago. It has been frustrating. It's starting to pay off. And Friday I saw, or maybe Thursday, I saw this chart that Tavi Costa, who I've had on my channel in the last couple of years. I've had him a couple of times. Hopefully I'll have him on again. He's from Crescat Capital. I've noticed that he's now gone on King World News, which is good. I think he's a clever guy. He's also originally from Brazil, like I am. A lot younger, though, of course. He posted this chart on LinkedIn here. Miners to gold ratio, weekly chart. Philadelphia Stock Exchange gold and silver index versus the gold price. And this is a really significant chart, I think, because if you look at this chart, it's going back to the early 90s. And then since then, of course, we've had a massive secular bull market in gold since 2001. We've gone from around 251 to 2000. And yet, miners have been really on a relative downward trend versus bullion. And the fact that we've broken this line, this 26-year downward trend, as Tavi says, I think is highly significant. And it shows that the bull market in gold and silver that I think we're going to see in the next few years, or the bear market, it's really a bear market in fiat currencies, and the dollar will be included, every currency. People who think the dollar index is a good indicator, they need to realize that the dollar index is a measure of fiat currencies. You have to measure the dollar versus real things. So I think there's huge potential in the miners. Does that mean I'm selling my gold and silver, my bullion, and going into the miners? No. And this is personal. I want that solid foundation of savings. Yes, I might increase my holdings in the gold and silver miners through fiat, spare fiat that I'm able, for example, to maybe accumulate at the end of the month. Instead of buying maybe 100% of gold and silver bullion, I'll buy 50%, and the other 50% I'll put in some of the miners. But I'm not like getting rid of my existing stack and I continue to stack. That's what I'm trying to say. Every person, every individual has his own risk profile. I have said in the past that there's a risk for the financial system whereby brokers, banks, they could be in trouble and your investments get trapped in there for a while. You need to realize that you could do really well in terms of price, but if your broker goes bust as well, you have to think about those things. But at the same time, you can't let that put you off. And I'll admit that maybe sometimes in the past that's led me to be too cautious. Am I saying I'm throwing caution to the wind? No, but there you go. So I think that's pointing to a very, how can I say, solid bull market, a bull market that we haven't seen maybe since the 70s, because we're breaking this line. So I've said many times in the past as well, maybe not as recently, but in a precious metals, gold and silver bull market, silver leads the way. And eventually when there's a big reset in terms of from paper to hard assets, like we had in early 1930s, when the Dow gold ratio went to around 2, and then in 1980, when the Dow gold ratio went down to almost 1, silver outperforms gold, and we see the ratio go down to like 15-1, which is the historic natural market ratio. You need 15 ounces of silver for 1 ounce of gold. Some people will argue that it could be less, but I'm going to stick to 15. As you can see here, the gold silver ratio chart is a daily chart, and it's going back to 2020. really late, middle of 2020, and we've been in a range here basically, trading around really just below 80, and it's going nowhere. So we need to see this ratio drop. Right now, you still need about 78 ounces of silver for 1 ounce of gold. So for me, we should see soon silver, in my opinion, outperform gold. And I would say the key level here short term would be if we break through 73, which was the low back in October last year. So there's still a long way to go there. So coupled with the miners versus gold bullion ratio or spread, I think this is important to watch. The other thing I would say, the commodities, general commodities, they've taken a breather. As you can see here, the Invesco Bloomberg Commodity ETF, that's kind of stabilized. We made a top in the beginning of March with the Ukraine war, and right now it seems to be consolidating. I think there's still a lot of opportunities as well in other commodities other than the monetary commodities like gold and silver. As for precious metals, yes, there's platinum and palladium. I think they will do well as well. I don't follow them as much because they're more industrial, but it doesn't mean to say I don't like those either. Yeah, the other thing before we look at the markets, just wanted to touch upon Newmont Mining. Newmont Mining is the biggest gold miner out there alongside Barrick Gold, for example. I do hold Newmont Mining, and it closed at an all-time high going back to the early 70s. And as you can see by this chart, it's broken through like a teacup formation similar to the one in gold bullion and in silver. The teacup in silver, of course, is like a 40-year teacup. And why is Newmont doing well and bullion not making an all-time high? Well, I think it's part of the miners now catching up. And I would say, though, within the miners, the junior miners, the GDXJ, that will outperform the Newmonts of the world and the Barricks of the world. Am I going to get rid of my Newmont and Barrick? No, because I think they're good companies. They pay dividends. And what I'm going to do, though, is try to accumulate more juniors from now, and even maybe accumulate more Barrick and Newmont. And the reason why I think the miners are catching up is because mainstream investment advisors, mainstream fund managers, they see that hard assets, gold and silver, will do well because inflation is not going to let up. The central banks cannot really raise or tighten that much unless they want to bring everything down. So it's easier for these fund managers to buy the miners instead of going out there and buying physical gold. You could buy GLD, but I think they've done some of that. So that's why this is happening, in my opinion. And I think Newmont is pointing to bullion, be it gold and silver, doing well soon. Patience, again, is another thing that is very important, I think, especially if you believe in the fundamentals and the technicals. And again, as I said, you need to do your own homework. You need to look into this as well. You might want to look into the prospectus of GDX and GDXJ yourself. And instead of buying GDX, you can buy some of the companies in there or some of the companies in GDXJ. And yeah, I mean, we are near the highs of the year in GDX. So it's up 26% year to date. Let's see, GDXJ, I think it's caught up a little bit. It's up, well, actually, no, it's still up only 17.5%, and we're near the highs of the year as well. So let's look at the markets then, see where they are this morning. It's 8:15 London time, 8:15 a.m., of course. So We've got spot gold at 19.29. It's up just over $4. The high has been 19.30.80. The low 19.15. So gold is up 1/4%. Silver is up about 3/4% or 18 cents at 24.81. High has been 24.86. The low 24.52. To the stock market, the Dow futures down 63 points, 0.2%. NASDAQ is down 32 or 0.2. And so is the S&P. It's down about 0.2 or 8 points. The FTSE this morning is unchanged at 75.40. And European Euro Stocks 50 is down 22 or 0.5% at 38.96. To the fiat currencies, sterling is up 1/8 at 131.29. The euro is down 1/8% at 110.32. Dollar's down slightly versus the yen, virtually unchanged, really, 122.55. And the dollar's up slightly versus the yuan at 6.37. Dollar's unchanged versus the Swiss franc, 92.55. Sorry. Aussie dollar is up 1/8%, 75.09, and the dollar is down 0.1 versus the Canadian dollar, 125.00, and the Kiwi dollar is up 0.2 at 69.34. General commodities, WTI crude is up 1% at 99.80. Brent is up just over 1% at 105.43. High-grade copper up 0.5% at 4.72, and U.S. nat gas is up 2/3% at 5.76. To finish off, let's quickly look at the Treasury market at the 10-year yield. That's up 2.5 basis points. That's at 3.40 right now, and the 2-year yield is at 2.46. So we are inverted 2s to 10s. And we are also just about level 2s to 30s. I think we closed just in about 2 basis points inverted on Friday, 2s to 30s. And that's the first time this has happened since 2008 or just before the great financial crisis. A bad sign for the economy, an inverted yield curve. If you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel if you haven't yet. And you can also follow me on Rumble, Twitter, Facebook, and all these other platforms below here. I wish you all a great day. Take care. Bye.